Hello and welcome to the quarterly performance segment of Making Sense of Markets Q1 2017. My name is Sheldon McFarland and I serve as the Vice President of Portfolio Strategy and Research at Loring Ward, and I'll be your host for this segment. Looking at a macro view of performance around the globe, we see positive returns for the quarter in all of the major regional markets. Returns were positive in North America, but even higher in other regions around the world, partially due to a declining dollar which fell 1.8% for the quarter. Returns in US dollars for the quarter were 5.9% in North America, 12.1% in South America, 7.4% in Europe, Middle East, Africa, and 9.2% in Asia. Zooming in on performance for the first quarter at the asset class level, we saw positive results for most asset classes, with large growth companies leading the way in US markets and small growth companies leading the way in international markets. Looking back at the last 15 years, we see both U.S. and international stock markets rewarding investors who stayed invested, particularly in the small and value segments, with 15-year annual premiums of 1% and 0.7% for U.S. small cap and value companies on average, and 4.1% and 1.2% for international small cap and value companies on average. Investors who stayed invested and followed our strategy of tilting towards small cap and value companies, both in the U.S. and international allocations of their portfolios, were rewarded with higher returns than a non-tilted portfolio over this period. The rewards for investing in small cap and value companies are not guaranteed though, and there have been periods historically where they have underperformed. As we can see when looking at a graph of the difference in 12-month rolling returns between small cap companies and large cap companies in the U.S., small cap companies had underperformed large cap companies for most of 2013, 2014, 2015, and 2016. It wasn't until the last quarter of 2016 that small cap companies began to outpace their large cap counterparts. The difference in relative performance will shift dramatically over short periods of time, with the end of 2016 being a prime example. While the results over any 12-month period can vary significantly, when we look at long periods of time, we see that on average, small cap companies have outperformed large cap companies in the U.S. by 2.7% per year since 1972. The same can be said when looking at the 12-month rolling return differences between U.S. value and U.S. growth companies. The difference in relative performance shifts dramatically over short periods of time, but when looking over the long term, we see value companies outperform growth companies by 1.63% on average over 12-month rolling periods. Looking at the most recent quarter's asset class returns, we see asset classes in your portfolio ranging from a positive 10.2% for emerging markets value on the high end to a negative 0.3% for U.S. REITs on the low end. Maintaining a diversified asset mix, such as the 65% stock, 35% bond mix shown in white, earned a return that matched the return of the U.S. large asset class over the last 15 years, but with significantly less risk, noted by the lower standard deviation. Maintaining a diversified asset mix also kept you away from the more extreme negative returns that the U.S. large asset class experienced from year to year, like the negative 22.1% return in 2002 and the negative 37% return in 2008. This chart shows the contribution the different asset classes in a 65%, 35% index mix and its return for the quarter. U.S. large was the biggest contributor because it had one of the highest asset class returns and is one of the larger positions in this example asset mix. International large value was also a significant contributor because it also had relatively strong performance and is a significant portion in this example asset mix. The only detractor was U.S. real estate, which has a relatively small impact on the portfolio return because it has slightly negative performance for the quarter and represents a very small portion of the assets in this example mix. Overall, the asset mix in this example performed as expected given the overall market conditions for the quarter. To review this or past commentary, please see the Making Sense of Markets portion of Loring Ward's YouTube channel. This concludes our presentation for today. Thank you for joining me. Until next time, goodbye.